Today, we're going to be talking about the new bill, Trump's big, beautiful bill, whether you think it's beautiful, whether you think it's ugly. There are some things in it that are really affecting short-term rental investors, property managers, co-hosts. You guys should know about this too, specifically around the 100% bonus depreciation that is coming back. So over the last few years, the old administration, the Biden administration had been phasing out 100% bonus depreciation and the tax credit you get. And it's affected investing in short-term rentals and investing in anything, right? Whether it's a car or something for your business, a building for your business or machinery or anything like that, the depreciation schedules were a little bit different. So that's what we're going to be talking about today and how you can save, 5, 6. There's definitely people who are saving 7 figures through this loophole that is specifically for short-term rentals. This is a loophole that I have used 4 times on 4 of my properties. And this was, really the main reason why I got into short-term rentals at the beginning was back in 2019. And I looked at that and we were paying about 25% in tax. So I looked at that and I was like, holy wow, we are paying a lot of taxes. Why are we doing that? And so I just started to understand the tax code. And at that same time, I was listening to Bigger Pockets and just trying to figure out different ways to build passive income or build income on the side that was not me traveling 180 nights in a hotel, which is what I also did in 2019. So I was kind of burnt out at that time. And so that's why I landed on short-term rentals because of this loophole. First of all, the biggest thing that you need to understand when you're doing your taxes is you have taxable income, and everybody in here should understand this. If you're probably less than 30 years old, maybe you don't, and you're just like, hey, whatever, that's something my accountant does. So your taxable income is all the income that you've made, you get taxed on, right? But then you have deductions. You have all the different deductions, whether it's you're taking that standard deduction or you've got business deductions or you've got rental income that has deductions as well, or rental activity that has deductions, and you own buildings that need to be depreciated. So the government basically gives you a deduction based on the age and how old the building is, but then also how old and the stuff in your house, the furnishings, the countertops, the cabinets, the amenities, all of those things get put on a depreciation schedule. So basically the government's saying, hey, you're investing into the economy. You're investing into the houses. You're investing into buying real estate. You're investing into furnishing the houses with the amenities, with the couches, with the beds, with the art. You as a owner of this piece of real estate are investing into the economy. So we're actually going to credit you. We're actually going to encourage you to do that. And that's why the government gives you these tax deductions or these ways that you can reduce your taxable income so that instead of that money going to the government, the money goes to the local or even the national economy, right? The businesses that you can buy from. So you have your taxable income and then you have your deductions, right? Now, rental income is typically passive, okay? So what that means is it is not considered W-2 or really business income. And that has the same thing for deductions as well. So by default, all rental activities are passive. So that means passive losses. So if you buy a long-term rental and maybe you put some art into it, but you buy a long-term rental, it gets put on a depreciation schedule that gets depreciated. So that schedule, basically is a deduction every single year on your income. Okay. So let's say you make $10,000 a year from a long-term rental. The depreciation schedule comes into account. Let's say it's $500 a year. Your net income, your passive net income is what, $9,500, right? So that is your passive income. That is not your active income. So that is not your business income or your W-2 income. And that's very important to understand. Very, very important. Short-term rentals are actually considered businesses. So they're considered not passive when you meet a certain criteria. So the short-term rental businesses are non-passive or not passive when you meet a certain criteria. And this is the most important thing. Long-term rentals are always going to be passive, pretty much always. And then if you're, doing office building or I don't know, just like typical rental income is seen as passive. But short-term rentals, when you meet criteria, it's very important, is considered non-passive. Okay. So when it's considered non-passive, Then you can take those losses that you have from the depreciation, from investing into that home, those losses you can take to offset your active income. And that's really where you can turn a, $380,000 income. If you just look at it, and I'm just going simple math here, and let's actually round up. Let's round up to 400,000. So it's a $400,000 W-2 income or business income that you have. Okay, and you're paying 24% in taxes. That's $96,000 right there. So that's $96,000. Now, if you have one short-term rental where you have a $100,000 loss on that short-term rental in the first year because of the depreciation schedule being accelerated, or because of you invested a ton of money, not including the down payment, right? That goes to the equity of the home, but the net income is negative $100,000, then you're basically carrying over $4,000, or I'm sorry, you're paying $4,000, or your taxable income is $4,000, right? So that itself is the loophole, and you have to meet that certain criteria. So the certain criteria is the average period of stay has to be less than 7 days. Okay, so that's the first one. That's what makes this business non-passive. It's because it is, you're actively managing people. You're managing the cleaners, you're managing the maintenance of the house, you're messaging the guests and everything. So this is why it is considered a active business. That's the first criteria that you need to hit. The second is the average period of the customer use needs to be less than 30 days. I'm sorry, less than 7 days. So that's the number one. So think of like Airbnbs, Verbos, hotels, like motels as well. So if you're doing hotels and motels, this is what considers it, mainly a business. So there needs to be at least 2 stays really throughout the year to determine the average length of being 7 days or less, right? And then the second step that you need to hit is you need to materially participate in the management of the property. So you need to be the person managing it. You need to be the person managing the cleaners. You need to be the person managing the maintenance people. You need to be the person. So whoever's taking this deduction, whoever owns this home, you have to materially participate more than any other person that is doing this. So you can't have a property manager. Okay. And I'm going to talk about that in a little bit. You can't have a property manager. You can't have a co-host in this, really in the first year. Okay. So you have to either 1, do all of the work. 2, you need to do 100 hours or more than any other individual. And then 3, this is another step that you can hit, or another criteria you need to hit. You need to hit 500 hours or more during that period. So basically at the end of the day, this step is you need to be the one managing the property in the first year. Okay. So the everything that entails managing the property in the first year is like managing the bookings. You can't have a property manager communicating with the guests, collecting the rents, doing like repairs and maintenance and stuff like that. In year 1, you need to be the one managing that property. Now, I do get this question a lot too. If you have a partner, so let's say you buy this house with your brother, or you buy this house with a family member, or you buy this house with a partner, the losses that you take are split between you and them. So if you own 50% of the house, they own 50% of the house, you guys both need to manage that property. You can't have a property manager. You both need to spend more than that 500 hours that I was talking about. Then you guys can both take that non-passive, and you can take that loss and deduct off your active income. Okay. So just to recap, 1, in order to qualify for this being a business, right? A business that you can offset your active income or your W-2 income, it needs to be stays less than 7 days. And you need to be the one managing the property, at least in the first year. If you do those 2 things, you'll be good. Now, you need to track your hours as well. So all the time that you're managing this property, you should be tracking your hours. You can track it in a spreadsheet. I think there's like reps tracker or something like that. And that's another question I get a lot is like, do I need reps status? And my answer is 1, talk to an accountant, but 2, if you're the one managing the property and the stays are less than 7 days, you're fine. You just need to track your hours, because the IRS would come and say, hey guys, we're actually going to audit you. Can you show me that you're the one managing the property? And can you show me the hours that are associated with that? And then can you show me all the receipts of all the stuff that you bought so I can see that these losses are actually true? right? And you're actually reporting and you're not cooking your books. Okay. So personal use of a short-term rental. So a lot of you guys and a lot of my friends as well, like I've helped out Dylan and Kirk and a lot of different people buy their first short-term rental, ask about using the property. So they're also using it for, for themselves as well as vacation homes, right? So if the personal use is less than 15 days a year, you're good. All right. So that's another big piece of it is you can't be using it like all the time in that first year. In the second year, there's a little bit different rules. But in that first year, to be able to accelerate the depreciation and get 100% bonus depreciation in that first year, you need to be able to manage the property yourself, 7 days or less, and use it less than 15 days right, out of the year. Now, if you're staying in the house and getting the house ready, you need to be able to show those hours. And if maybe it takes you more than 2 weeks to set it up, there's some gray area there, right? But you need to be able to show your hours. And at the end of the day, show that this is a business, especially in the first year. And it's not just, a vacation home that you're trying to just fit a round peg into a square hole, right? So some tips here. Number one, use it less than 14 days in the first year. If your family uses it, you're probably going to want to consider it personal use unless they pay fair market rent. It's another question that I get all the time. And you don't want to get fair market rent the whole time, right? You're not going to want to give people huge discounts. You're not going to want to give family and friends a discount to stay there in the first year. Cause then, if you do get audited, the IRS is going to be like, hey guys, this is you're paying, somebody's paying $100 a night to stay here, but then somebody else is paying $1,000 a night. Like this is just a vacation home, right? This is not a business, right? You're not making money. That's why you have all these losses. So you need to also offer substantial services, or if you're doing a hotel or a bed and breakfast or something like that, that's also in the tax code too. You don't need to worry about that if you have a vacation rental or short-term rental, if you're staying there less than 14 nights. And then again, manage that property yourself, at least in the first year. So those are the main things that you want to look at. Now, once you've done that, you can do what's called a cost segregation study, and you can get bonus depreciations. General rule of thumb is like why, and I talked about this earlier, why depreciation is important is all the expenditures on your home that you benefit from that are more than the first year can be capitalized. Right. And the second rule of thumb is capitalized on a straight line basis. So depreciation is a non-cash expense that offers incredible tax avoidance for business owners and landlords. So I mentioned it earlier. It's a non-cash expense, depreciation, that you can get basically a credit for all the stuff that you bought. Right. So there's a lot of different things. There's, land improvements that have typically a 15-year useful life. There's personal property that's like a 5 and 7 year useful life. 25 and 2026 and 2027, you're now able to get 100% bonus depreciation for your property in that year that it's placed in service. Okay. So I'm going to run through an example here. If you buy an $800,000 house, okay, and that $800,000 house gives you, let's say you put 10% down, so it's an $80K down. Let's say you put another $80,000 into it, closing costs like 3%. It's $184,000 that you put into the house in the first year. Okay. So let's say that $800,000 house, the building is worth, let's say 80%, and the land is worth 20%. Now you can pull this from like a GIS tax record or something like that. But if you go to like your county tax record, they typically can tell you how much the building is worth and then how much the land is worth. So if you buy the house for $1 million, well, actually in this case, you buy this house for 800,000, and the building is worth 80% and the land's worth 20%. Then the basis for that building that you're going to depreciate is $640,000. So you can take that, and if you're in the 24% tax bracket, you're looking at probably like a $160,000 deduction that you're able to bonus depreciate in that first year, which in turns comes out to be about a $40,000 tax savings. Okay. So your tax, a $40 straight dollar for dollar tax savings is done through doing a cost segregation study, which is basically just looking at every single piece of the property. So looking at the building, looking at the amenities, looking at the furniture, and figuring out how much those things are worth, putting that on a cost segregation study, and then putting that depreciation schedule together and using that to create essentially a massive loss in the first year. And I did it live. This was probably like 6 months ago now with Thomas Castelli, who helped me build this calculator because it breaks down like dollar for dollar how much you can save just by investing in one short-term rental. And it's, again, the biggest thing is it's non-passive. So it's not a passive, it's not deducting your passive income. It's actually deducting your active income. So if you're making $400,000 a year and you get to reduce that by reduce your taxable income, which is right around 100 grand, by $40,000, you're almost cutting your tax bill in half, literally in half, by investing into this property. So your cash on cash return goes way up. In this case, let's say it brings in 125 grand a year. Your cash on cash return would be about 15% before any tax savings, and then add on that 40K of tax savings, your cash on cash return is like 19-20%. So it can turn like an okay deal into a good deal. It can turn a really good deal into a great deal, right? So that's what you need to look at if you're investing. Now, if you're co-hosting or if you're managing a property, the biggest thing to look at here is speaking with investors about this. So yes, you're not able to manage that property in the first year, but if you're able to consult with that homeowner and say, hey guys, if you guys buy this property, I will help you set it up. I'm not going to do more hours than you. You guys are going to do the majority of it, but I'll help you set up like your tech stack. I'll help you set up Hospitable. I'll help you set up price items. I'll tell you, this is kind of what you need to charge, and I'll charge you for that time. Right. And maybe it'll cost, $5,000 for, let's say, 50 hours of my time or 20 hours of my time, or maybe I'll meet with you weekly to find this property. And then we can meet weekly as you guys build it out. And then we can meet weekly to, or maybe it's bi-weekly, maybe it's monthly, right? But, you guys give me a consulting fee. I'll help you out. You guys are able to take these massive tax deductions in the first year for this property. But then in year 2, if you want to hand over the property to me and my company, this is what it would look like. And this is what I think you would make in return. And you wouldn't have to do any of the management of the property. It's a really compelling offer for somebody, if they're going to save $40,000, but you're going to pay them, they're going to pay you $5,000, but you're going to save them $40,000, and they're going to get, cash flow every single month, and they're going to get a vacation home, for investing, let's say $200,000. That's a pretty dang good deal. It's a good deal for them, and it's a good deal for you. So I know you guys, if you're thinking, oh, well, this is not for me. If I'm a co-host or a property manager, this is not for me. Yeah, it is. You just need to be talking to the right people, and you need to be consulting on the right properties, right? So it's a loophole, not only for investors, but it can be for property managers. It can be for co-hosts as well. So you don't want to skimp on that. So that's really it for today, you guys. If you guys have any questions, if you want to dive deeper on this, all you need to do is just comment taxes, and I will happily jump on a call with anybody who wants to talk about this and just go through the numbers, because this honestly changed my life when I first discovered this. And then I've helped 3 people this year. So 4, Will, Kirk, Jeff, Dylan, all friends of mine. I helped find the right property for them, and help them design it, make sure it looks good, put together some estimates, put together the tech stack, that sort of thing, to make sure that they're set up really well for year 1. And I may take over the properties in year 2. That would be great, but I at least had control over, hey, this is the way the design of the property should look like in order to maximize your return. Right. So that is just based on the data, that is based on the markets that I've looked at, and just, doing this for 5 years now, 4.5, 5 years. So if you guys have any questions on this, again, just comment taxes, whether you're listening to this on the podcast. You can find me in the Short-Term Rental Secrets Facebook group. All you got to do is go to Short-Term Rental Secrets, look up Mike Riley. I post in there every single day, and just shoot me a note or just comment, hey, Mike, heard you talking on the podcast about taxes. Let's hop on a call and discuss it. So that's it for this week. I will see you guys next week, and I hope everybody has a great rest of the week.